Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, we certainly have seen some very strong equity performance to start the year, but it really has been waning over the past couple of weeks with a number of factors that investors are considering. So I wanted to bring you some big picture thinking today in terms of perhaps where we're at now and where we go for the remainder of the year so you can try to prep and position yourself appropriately. For the conversation today, we have Myles Zyblock joining us. He's the Chief Investment Strategist at 1832 Asset Management. Myles, always great to be able to get your perspective and to share with our viewers. Thanks so much for joining us.
It's really nice to be back, Catherine. Thank you.
Thank you. Let's just start kind of big picture with how you're looking at the world. I mean, I was pretty excited to start the year and seeing that, all of the damage that had been done in 2022 was starting to get repriced to the upside, maybe leveling out a little bit, but it really is petering off here for a number of really key and important factors. So we'll talk about those factors, but where do you stand right now as you look at the big macro picture?
I think the macro picture is still pretty challenging. It's, these central banks are globally are caught between sort of a rock and a hard place, and that space between those two objects is getting tighter. Like you say, the narrative seemed to have switched. I'd call it February 3rd, and I'm going to put that date out there. And the reason I believe things changed for the market were largely in response to a very, very strong U.S. employment report where, jobs numbers came out at, I think, 500,000 jobs in the month versus expectations of something like 189,000. And so, we were expecting this slowdown that would eventually lead to maybe the end of a tightening cycle. And that all seems to be changing now because of this strong jobs report. And that jobs report was followed by, right back to back, strong retail sales numbers out of the US. And then you had some, let's call it sticky inflation numbers from both the US and Europe. So I think the narrative's changed again, and people are thinking maybe this hiking cycle or this tightening cycle has more to go.
So a couple of points I want to pick up on there. One, with respect to the labor market, many economists will say that is a very backward-looking factor to consider. Is that accurate?
That's 100% accurate, yes. So the central banks are keying, at least let's talk about the Federal Reserve, is keying off of labor market indicators like the unemployment rate or jobs growth, and off of inflation, the inflation numbers themselves. And both of those are lagging indicators, meaning that it takes a while for the slowdown to impact jobs and inflation. And so they are sort of looking in the rearview mirror. And this is what, has the markets a little bit concerned that they'll continue to raise rates maybe beyond the point of comfort. And the worry is, at least from my perspective and a lot of, let's call it the bond market's perspective, because the yield curve is deeply inverted. The worry is they're going to over tighten and cause an economic downturn.
Right. It's interesting as well. One other factor that you pointed out, which I'm curious about, are the retail sales numbers as well, because I think that we would have expected that there would be more damage done to the consumer. And I really think, if you're observing the consumer and I think the lack of traffic in stores and out and about, I think that the consumer is probably weaker than the numbers are indicating.
I think there are indications that the consumer is starting to soften a little bit. I mean, you see housing data is a very early turning indicator, and housing data is really starting to drop very seriously. Mortgage applications in the US are falling again. And I guess, there is a sense of confidence and what that does to consumer confidence when your house, your largest asset, is under downward pressure. You're also seeing it in little pockets of stress with the consumer. One is subprime auto loans. Delinquency rates for subprime auto loans in the US are starting to rise. In fact, they've taken out prior highs. So there is some stresses building for the consumer. I suspect, though, that as long as the jobs market holds in, consumer spending is going to hang on. The issue is corporate earnings, Catherine. And as corporate earnings slow, eventually we could see job shedding.
Right. We're going to pick up on that on the other side of the break because it's been interesting to see the PE, the multiple pull back in 2022. But now the question is, what about earnings and what do they look like for 2023? We'll be right back.